It's Friday, 12th of September, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, why oil is shrugging off geopolitical upheaval and the future of OPEC. But first, to catch up on the past, present, and future of global macro and markets, it's Group Chief Economist Neil Shearing. Happy Friday, Neil.
Hi, David.
We've got a busy week ahead. Lots of data releases coming up. But I guess the obvious place to start is with all of these central bank decisions in the coming week, not least the Fed decision that's due on Wednesday. At this stage, it looks like 25 basis point cut is baked in. What are the chances of a surprise from this meeting?
Yes, you're right. 25 basis points, I think, is baked in, is pretty much fully priced into the markets now, isn't it? To the extent that the markets are pricing anything different, it's whether there will be a 50 basis point cut to the Fed funds rate. Now, it's possible we get a larger cut. Clearly couldn't rule that out. It's notable, isn't it, that the administration seems to be trying to rush through the confirmation hearing of Stephen Myron to get him on the FOMC ahead of this meeting. Whether or not that materializes, let's see. However, I think if you take a step back and look at the data in the US, I mean, yes, we had those massive revisions to the payrolls numbers, the benchmark revisions to the payrolls numbers that were released earlier this week. But if you look at the real activity data, it's not actually that bad. So we wrote a note earlier this week, essentially doing a health check on the state of the US economy. And it's pretty clear that hiring has slowed. But if you look at real business sales, if you look at personal incomes, if you look at industrial production, these are the other key coincident indicators in the US, they're all still trending pretty much in the right direction. So it's not obvious, putting payrolls to one side, it's not obvious that the economy needs a big jolt in the arm. So my sense would still be that 25 basis points is the most likely outcome here.
You say that activity is holding up, but scan the headlines and the balance of opinion does seem to be shifting towards the economy, either edging towards recession or already being in one. And it's not from the hysterical corners of the commentary. I mean, this is coming from fairly sober-minded people. So what's the counter-argument? What are the risks to the US economy?
The counter-argument is the one that I just put forward, really. Yes, it's clear that the labour market is cooling and that hiring has slowed. But if you look at the activity data, it appears to be holding up. So if you look at GDP growth over the 12 months of the first quarter of this year, it increased by 2%. GDP growth then increased 3.3% Q-on-Q annualized in Q2. We have it tracking at 2.7% Q-on-Q annualized in the third quarter, according to our GDP nowcasts. So if hiring is slowing but activity is holding up, then the counterpart to that must be that productivity is picking up. And we're starting to see, if you look at the non-financial corporate productivity numbers, they're picking up and above 3% year on year now. So I think the counter argument to the idea that the economy is kind of spiraling into a recession is that actually the activity data so far appears to be relatively robust. And so perhaps it's productivity growth that is accelerating. Now, of course, there's always a risk that what happens is that if hiring slows, then that eventually starts to feed into weaker consumer spending, and that feeds back into weaker demand, which in turn leads to another slowdown in hiring. And we have this feedback loop, reflexivity, if you like, within the economy that leads to a recession. But payrolls are a coincident indicator, not a leading indicator. And at the moment, it's not obvious that we're getting this element of reflexivity. Now, not to say it won't happen, but it's not in our base case.
So that's an argument, though, for a more cautious approach to policy easing than certainly Donald Trump would want, Scott Bessent would want. What do we think is the path of rates going forward? And is that going to be enough to satisfy the White House?
Let's break those two things down. The path of rates going forward, we have penciled in 50 basis points of cuts over the rest of this year. So 25 basis points in September, and then another 25 basis points before the end of the year, probably December. And then we've penciled in another 50 basis point of cuts in the second half of next year. So that would be after a new Fed chair has come in. So we have 100 basis points of cuts between now and the end of 2026. Now, the market has more than that. I think it's currently pricing in close to 25 basis point cuts. So we're a bit above the market profile. But as I said, we're not anticipating a marked slowdown in the US economy. If anything, actually, period of softness, certainly in the second half of this year and the start of next year. But the story of 2026 might be one of a re-acceleration in economic growth, at least in our forecasts. So we're not forecasting a marked slowdown or period of weakness in the US economy that would justify further rate cuts. Now, your question was, would 100 basis points of cuts be sufficient for the administration? Well, on the face of it, no. But then in order to justify more than 100 basis points of cuts, you need a substantially weaker economy, I think. Presumably, the administration doesn't want to see that either.
What about on the inflation side? We had fresh inflation data this past week. What's the story there?
Well, at a headline level, we had a 0.4% month-on-month increase in the headline CPI number. That was a bit stronger than was expected. And core inflation increased by 0.3% month-on-month. That was broadly in line with our forecast, actually. So core doing essentially what we expected in the August data, but headline being slightly stronger. Now, when we break down the components of that inflation release, of course, the Fed looks not at the CPI numbers primarily. It looks primarily at the PCE numbers, and in particular, the core PCE deflator. And the components look like they were consistent with a kind of 0.2% month-on-month gain in core PCE, which would be about consistent with the target, the Fed's target. So headline CPI stronger than expected, but the components suggesting that the core PCE numbers might be running around the Fed's target. Now, still, take a step back, still not much evidence of tariff inflation in the CPI numbers overall, but we are starting to get some evidence both in the core CPI services numbers and in some of the survey evidence too. So if you look at the ISM services prices paid balance of services inflation starting to pick up. So that's something that I think the market's focused on tariff inflation. When's the tariff inflation coming through? Actually, I think we should be keeping a closer eye on what's happening in services, because there's some evidence there. The price pressures in the service sector are starting to pick up.
You mentioned signs of improving productivity growth in the US, and it reminded me this deal that we've seen over the last week. OpenAI and Oracle have this $300 billion 5-year deal for Oracle to provide computing power to OpenAI. What you were saying there about the activity showing perhaps an improvement in US productivity growth, are we seeing signs of all of this investment in AI feeding through to the real economy, or are we just still waiting to see whether or not this is all just a big bubble that's going to burst?
Whisper it quietly, and there might be some signs under the surface that the AI boom is feeding into the real economy. Now, it's certainly the case that if you look at business investment generally over the past year, it's been pretty weak. But if you dig beneath the surface, there's been one area of strength, and that's been investment in IT hardware and software. So if you look at the software numbers, investment's grown at 10% year on year. The IT hardware numbers, 20% year on year. So almost all of the strength of investment, the positive growth of investment, has come through IT hardware and software investments. The contributions to any positive growth has come from those two sectors. So it does seem to be that I think you can make the case that we're starting to see the positive effects of an AI boom, or the early stages of an AI boom feeding through into the real economy. Of course, that's where we would expect to see the effect of the AI boom coming through first in investment, particularly in IT software hardware. Then the question then is, does it feed through into productivity growth? Now, we've just spoken about how productivity growth might be picking up. If that's sustained, then I think we start to get a sense that, yes, maybe AI is feeding through into faster growth in the US. Interestingly, though, we're not really seeing evidence of this in other economies. So again, that speaks to this idea that amongst advanced economies, it's the US that's leading the charge on AI, and it will, I think, reap most of the benefits from the AI boom. That's consistent, of course, with our AI Economic Impact Index.
I was going to ask that because, just going back to central banks, we've also got a Bank of England meeting this coming Thursday. We've just had an ECB meeting this past Thursday. And I wanted to ask, how different is the economic world that these banks are operating in or trying to calibrate policy in versus the Fed?
Well, the political world obviously is very different. These central banks are not under any type of political pressure to cut rates or set policy in a certain way, at least not to the same extent that the US is. I think there's potentially three challenges that these banks are facing, though, that sets them apart from the US. I mean, the first is that the growth outlook is just the actual growth numbers are much weaker. So I've just said that our measure for US GDP growth, our nowcast for US GDP growth in Q3 is currently tracking at 2.7% Q on Q annualized, despite all the recession fears, and the productivity growth might be picking up. We're talking just after we've had July GDP data released for the UK, and that's showing 0.2% Q on Q. Obviously, not annualized that, you get to somewhere between 0.8 and 1% Q on Q annualized. So the UK economy growing at pretty much a third of the rate of the US economy. And it's a similar story in the Eurozone. So first difference is much weaker growth. Second difference is that there's some market pressure starting to build in some parts of the European economy, particularly at the long end of the curve. Now, we're speaking in a week where US 30-year yields have fallen by about 30 basis points. So a lot of that kind of pressure at the long end has eased. And we've seen some falls in yields at the long end of the curve in Europe too. So UK 30-year gilt yields down by about 15 basis points or so this week. But the falls have been much smaller in the long end of the curve in Europe. And yields at the long end of the curve increased much more over the summer months in the UK and in France and in Germany. So I don't think this is the start of some kind of economic or financial crisis or fiscal crisis, if you like. But I do think it's something that central banks are going to have to increasingly keep an eye on because it feeds through into financial conditions. And we'll have the Bank of England meeting over the coming week. Almost certain that interest rates are going to be kept on hold, but there will be a decision to be made about quantitative tightening, QT. And I wouldn't be surprised to see the pace of QT perhaps slowed, which might help to alleviate some of these pressures at the long end of the curve. And then the final thing, as it relates to particularly to the UK, this isn't so much for the Eurozone, where inflation is now pretty much back to its 2% target, but it's still an issue of stubborn inflation in the UK. And that really sets the UK apart from the rest of the Eurozone. We think that about 2/3 of the inflation differential between the UK and the Eurozone can be explained by administered prices effectively, or the pass-through of tax changes or minimum wage changes through to consumers. So that should, in theory, wash out over the next 12 months or so. But the UK grappling with higher inflation for the time being than the Eurozone. And again, that's another reason why the Bank of England, I think, will be on hold when it meets over the coming week.
Neil Shearing there on a packed calendar of central bank meetings in this coming week. In addition to the Fed and the Bank of England, we are also going to be watching Wednesday's Bank of Canada meeting, where we are expecting a 25 basis point cut. I'm going to add links to the previews for all of these decisions to the podcast notes, as well as to our central bank hub, which is where you'll be able to view and download all of our policy rate forecasts for the major global DM and EM central banks out 2 years. The team are going to be holding their regular drop-in. These are our short-form online briefings. Just after the Bank of England meeting on Thursday, they're going to be reviewing the latest Fed, Bank of England and ECB decisions, answering your questions about where next for policy. Look out for a link in the podcast notes. These drop-ins are client-only events. If you're not already a Capital Economics subscriber, contact us at sales@capitaleconomics.com and we can get you on trial and make sure that you're on that call on Thursday. As I said at the top, lots of data this coming week, starting with Chinese activity numbers for August. But there's also UK employment, inflation and retail sales, Canadian and Japanese inflation, US retail sales, much more besides. At least some of this is going to be feeding into the team's discussion on Thursday, but they will, of course, also be providing the usual instant written responses and the follow-up analysis to all of these releases. Neil also mentioned the AI Economic Impact Index. This is our proprietary measure of which economies are going to be doing best as this technology rolls out. It's part of our research into AI's macro and market implications, and I'll link to that body of work in the notes, along with our US team's analysis on whether the US economy is benefiting from all of this investment. I'll also add a link to our GDP nowcast so you can see what Neil was talking about in terms of that current quarter reading. Now, this past week alone saw Israel striking Hamas personnel when they met in downtown Doha, and NATO forces scrambling to knock Russian drones out of the skies above Poland. This is a world of heightened geopolitical tension, and some would think that oil markets would be freaking out in response. But that's not what's been happening. To find out why, I spoke to David Oxley, our head of Commodities and Climate Economics, on Thursday, and we talked about the near to long-term outlook for prices. Here's that conversation now, and it starts with David talking about how prices responded to the news from Qatar and Poland.
Well, as expected, oil prices did tick up a bit in the immediate aftermath of both events, but the broader picture is that it subsequently gave up the gains thereafter. The lack of a lasting reaction is really a fact that the market is judging both of these events to not really endanger oil supply, which is the main conduit through which geopolitics can really move the needle in the global oil market. So for what it's worth, Brent crude at the time of recording this is broadly in line with where it started the week.
How do we measure the impact of geopolitics on oil prices? Given how much the geopolitical picture has changed in recent years, given how much more dangerous, frankly, the world is, why aren't oil prices showing more of the sort of risk built into it?
I think what we're seeing at the minute is that the oil market has been squarely focused on developments and the fundamental side of the market, particularly the weakness of demand and the looseness of supply and the incoming wall of supply. So I think that's really explains why the market has not been distracted by these events. I mean, in terms of risk premium in general, it's worth noting that this is a concept in the oil market. It's a very conceptually hard thing to identify or to define. It's more art than science, really. But it's always the case that you do know a risk premium when you see it, really. And the last instance of a substantial risk premium being built into the oil market was in June during the Israel-Iran conflict. That's when we saw oil prices surge from $65 per barrel to $80 per barrel very quickly, really predicated around the notion that the spiraling conflicts could lead to the nightmare scenario where Iran would move to shut the Strait of Hormuz and really choke off a vital artery in the global oil market. As it happened, that run up in oil prices we saw, I mean, it was very easy with hindsight to diagnose that as pure risk premium because as it happened, it came out, evaporated very, very quickly when it became clear that Iran's response to the US bombing of its nuclear facilities was very orchestrated. So I think the fact that the market hasn't reacted implies that the risk to disruption from recent events is some degree lower from what we saw over the summer.
So you talked about the demand story having a bigger influence on where prices are going. So talk about what that demand story is doing, because obviously at the moment, a lot of talk about a slowing US economy, this R word, recession, being bandied around. In China, our own China activity proxy, that shows the Chinese economy growing well below official measures, well below what most analysts are estimating. So putting all of that together, how does the demand picture translate into what prices are going to do?
I mean, the simple thing is the demand picture for oil is far from a picture of health. I mean, in the US, as you say, I mean, the signs of a cooling labour market we've got a really nice chart that we roll out every now and then that really shows a very strong relationship between developments in non-farm payrolls and oil demand growth. And the rough rule of thumb here is that you need to have 200,000 increase in jobs on a monthly basis to be consistent with flatlining oil demand. As we've seen this week with the benchmark revisions to the labour market come through, US economists are now estimating that jobs growth averaged only 70,000 in the year leading up to March 2025, which, to put it into context using that rough rule of thumb I mentioned earlier, is consistent with around about a 3% year-on-year fall in US oil demand. So US, big demander of oil, fundamentally not very strong. Put that together with, as you mentioned, in China. I mean, the key story with China, we've seen implied oil demand pretty much flatline since 2023. This is partly to do with structural headwinds to oil demand in China through the rapid rollout of EVs, shift away from diesel-powered trucks, all that sort of stuff. But as you said, I think there's certainly some of the more cyclical headwinds we're seeing, as evidenced by the cap, the increase in social security payments, cloud and the outlook for consumer sector. I think that's more cyclical headwinds for Chinese oil demand as well. So yeah, I think it's very hard to be too bullish on the oil demand side of things. What that means for oil prices, I mean, that would be fine in a sense if supply was very, very tight. But actually what we're seeing is that OPEC, as we saw in April, it pivoted to start to unwind some of its output cuts and bring more oil back to the market. What we've learned since is that they're just ploughing ahead with this plan. So we've got backdrop of weak oil demand and OPEC bringing more supply back to the market. In our view, this is consistent with lower oil prices.
Talk about that April pivot, that move from cutting production to increasing production. Why did it happen? How much oil has been released? And how far is this policy of trying to raise production going to go?
Yes, well, starting off with why it happened, there's a number of different strands of thought here. I mean, these cuts were meant to support oil prices, and they did for a while, but they've been less and less effective, partly because OPEC is not the force it was in the global oil market. So it's had to contend with supply coming online from non-OPEC producers, particularly the US, but also some in Latin America as well. So the rationale for them curtailing output to support prices has not been borne out in the data. And the pivot has really just shown that OPEC as a whole has got fed up with not being able to support prices at the same time as giving up market share. They've decided they'd rather just claw back some market share. So there's been a definite pivot in their behavior. As to how far down the line we are as to them unwinding their output cuts, I'll spare you the gory details, but the output cuts are split into a number of different tranches. They've got all the way through the first tranche, which was roughly worth about 2.2 million barrels per day. So since April, all of the announcements since then have committed to bringing that much oil back to the market.
So 2.2 million barrels, that's relative to daily global production in the region of 100 million barrels. Is that right?
Yes, that's correct. Yeah, exactly. And as we've seen more recently, they've now moved on to unwinding the second tranche of cuts, which is potentially going to bring another 1.7 million barrels per day of oil back to the market by the end of next year. One thing we should stress here is that the increases in the quotas and the announcements we've had from OPEC are not going to translate one for one for increases in oil production, partly because they weren't producing in line with what they said they'd be doing to begin with. So it's kind of more for context, kind of more for optics, what they're bringing back to the market. The other thing we should stress here is that as time goes on, there is quite substantial question marks as to whether all of the OPEC members will actually be able to increase production as much as they say they would do. Saudi Arabia and the UAE seem pretty well placed to do so, but there are question marks around the ability of some others to do that. So treat these numbers with a bit of a just supply. It might not come up by these precise numbers. But the key point is that, having pivoted their behavior, they are adding oil back into the market, which we do not think is particularly tight. As our current estimates is that the oil market is broadly balanced. But as we're moving out of the summer period into the sort of winter period of the Northern Hemisphere where oil demand typically falls away, I think the oil market, our forecasts are consistent with a substantial surplus opening up, which is part of the reason why we expect oil prices to come under pressure. And as we see next year, although we've heard from OPEC, I think it's fair to say that they are taking a cautious approach. So, as to whether they fully unwind their second tranche of output cuts immediately or actually kind of take a bit of a pragmatic approach, that remains to be seen. But I think, again, the bigger picture is as it stands, they'll be adding more oil into already what would be quite a saturated market next year. So, we think this is all consistent with lower oil prices.
Put some numbers on this. Just remind us of our forecast relative to where prices are at the moment.
Well, based on the supply-demand fundamentals we've just run through, we forecast Brent prices to fall from $66 per barrel at present to $60 by the end of this year and $50 by the end of next year, end of 2026. Invariably, obviously, there are clearly risks around this. One of the key risks to the upside is the extent to which Donald Trump's rhetoric on putting substantial secondary sanctions on buyers of Russian oil come to fruition. As it stands, the US has put a 25% penalty tariff on India for its role in buying Russian oil, although it hasn't done the same to China. And the news we've had this week is Donald Trump reportedly pushing the EU to adopt 100% tariffs on India and China to really put the pressure on Russia. we're dubious as to whether this is actually going to happen. But if it did, I mean, if there were factors at play that really took Russian oil supply off the market, well, I think Russian seaborne exports are, to put some numbers on it, around about 4 million barrels per day. So we're talking about quite large numbers. If there was substantial disruptions to that, it would be enough to move the needle at a global level. It's more of a risk to watch rather than something we've got baked into the forecast.
Even as all of this is going on, OPEC is preparing for the 65th anniversary of its founding. You published a report this past week to mark its birthday, which goes in some depth into the future of the cartel. You've talked about the structural demand shifts for oil. We kind of touched on these internal struggles that OPEC has had in maintaining cohesion. So put all that together and give us a sense of the kind of future that you see for OPEC.
Yes. Well, I mean, despite turning 65 and entering its golden years, I think that the thing we should stress is OPEC is still a force to be reckoned with. You know, it's in its current guise of OPEC plus, it still has two of the world's biggest producers of oil in its ranks, Saudi Arabia and Russia. It's got very low cost production in some of its members, particularly Saudi Arabia. And also, I mean, one thing that it has on its side is it's increasingly being positioned as a sort of political group rather than just a sort of economic cartel. You know, it's like a non-Western group of like-minded countries. So I certainly don't want to exaggerate reports of its demise as such. That said, as I go into in the report, I mean, from a cartel perspective, from an economic cartel perspective, history shows that cartels are strongest when demand for their product is really, really robust and competition from other sources is limited. And crucially, both of these aspects are starting to shift and be eroded at the edges for OPEC. So on the demand side of things, I mean, there's obviously huge question marks about the shape of demand over the long run as to whether we're close to a peak oil demand, how quickly oil demand could fall away or potentially even grow further. But I mean, the key point for all of this, even OPEC's forecasts, which unsurprisingly do not see peak oil in anywhere anytime soon, they're still consistent with oil demand growth slowing considerably over the next 25 years. So the next 25 years are going to look very different from the last 25 years in terms of oil demand, notwithstanding a huge amount of uncertainty around that. But I think the other aspects that's really starting to play out amongst OPEC is the emergence of really resilient supply from non-OPEC producers. Yeah, obviously the US energy revolution there. It's not the case that OPEC can really flush this away by lowering oil prices anymore. The cost of production has fallen considerably over the years. And we're also seeing quite low cost supply coming up from the likes of Guyana and Brazil. So yeah, I think OPEC isn't going to completely fade or fall out of the sort of public consciousness. But I think, these the longer term factors were going to become more visible and making life difficult for it over the long run. As to what that means for oil prices and oil supply, I think one key risk is that this manifests itself in OPEC members really deciding actually there's not much benefit of being part of a cartel anymore. Actually, if it's everyone's incentive to pump as much oil as they can, that is the exact opposite of an effective cartel. So it could be that it kind of dies a death of 1,000 cuts, really, where everybody ostensibly part of OPEC but actually just does what they want, in which case I think that would tilt the risks towards greater oil supply, lower prices, all else equal. But also I think it also increases the risk of more volatile oil prices to the extent to which some members might look to pump and they might then be punished by producers with lower production costs, which is very much actually part of the rationale, you could argue, what we're seeing now. Part of the rationale behind the latest pivot towards greater production is attributed to trying to punish the likes of Kazakhstan and Iraq, who have not been adhering to production quotas in recent years. So yeah, OPEC isn't going to disappear, but equally I think it's the peak cartel years are well behind it.
David Oxley there on the future of OPEC and the outlook for oil prices. His team are doing a drop-in this coming Wednesday to brief clients on the price outlook, but also to answer their questions about what's been driving gold prices to record highs and whether they could go much higher. Again, a link to that event will be in the podcast notes. But that's it for this episode. We will be back again next week with more from Neil and the team. Until then, goodbye.